Welcome back to Dividend Obsession. My name is Troy. Really quick, if you guys wouldn't mind subscribing to my channel, 1, it's free. 2, I appreciate the support. And 3, if you comment down below and let me know that you've subscribed, I'll personally comment to each and every one of you, thanking you for the support on the page. Also, I would like to thank Tia for the suggestion on today's video and the support on the channel. Disclaimer, any info in this video is not to be taken as advice, and you should always do your own research before deciding where to put your money. Now let's get to the content. All right, so what I wanted to talk about in today's video is what are widely considered to be the top 3 options for investment brokerages. Not only that, but why they are considered to be the top 3 options and the pros and cons to each. Then I'm going to get into what are some of the other options based on your investment style and your investment experience, the pros and cons to each of those. And then lastly, we're going to go over the key takeaways and things to consider from this whole video. All right, so the top widely considered investment brokerages are going to be Fidelity, Charles Schwab, and Vanguard. All right, so I wanted to get into why these are all widely considered to be the top 3. And the first reason is because they all charge minimal fees. And this includes a $0 commissions on stocks, mutual funds, ETFs, and options. They all offer low-cost index funds. They all have really good research and educational tools within the sites. They all offer the ability to invest in different types of asset classes, which is really good for diversification. And then you can also do banking, retirement, and or trust funds for children within these brokerages. Basically, these options will be a one-stop shop for most investors, and that's what makes them the top 3 widely considered investment brokerages. All right, and with all that being said, I wanted to get into Fidelity first. So as I mentioned, we're going to go into the pros and cons of each, and then a little bit of bullet points, good things to know on each one as well. So with Fidelity, some pros that we have is Fidelity is very inexpensive. So they do not use payment for order flow, which ensures that you get the best price for your investments, which is key. Obviously, the lower you can buy a stock, the higher it goes. The difference is how much you've made. The more you make, the more money you have. You know, that's kind of self-explanatory. The next pro is that Fidelity has top-notch research. So they have insights from 20 different third-party research firms. And they also have an intuitive stock screener on their website. So if you're a customer of Fidelity, you have access to these tools for no additional charge. And, you know, the knowledge is there. It's out there for you. At that point, it becomes what you want to learn. And speaking of what you want to learn, Fidelity also has a very, very, very strong and a lot of educational content. So this includes free in-person help, investing seminars, and strong learning centers. So the learning centers where you can go and you can learn about different things with investments, the intricacies of investments on your own time. It's kind of like college, except you don't have to go into debt for it. So, and let's get into some of the cons with Fidelity. The larger majority of funds are pricey. So this is not necessarily investing in individual stocks with Fidelity, but if you were to get Fidelity's index funds or Fidelity's ETFs mutual funds, some of those have higher fees, but there are other options, and you can buy other investment brokerages, mutual funds through Fidelity as well. Like you can buy Vanguard funds on Fidelity. So it's not like you're limited to that type of mutual fund or index fund or ETF based on the brokerage that you pick. So that's really nice. And then the tools that I was mentioning with the research and the strong educational tools and the pros, the con to that is it's not organized fantastic. Like all the tools are located on different tabs and different pages, and sometimes things can be a little hard to find, but this is where a Google search typically comes in handy, where you could say Fidelity and then whatever stock screener, and it should pull it up for you, and that'll make it a little bit easier. So other takeaways from Fidelity is there's a $0 minimum deposit, so you don't have to have a absorbent amount of money to open an account with Fidelity. There's different accounts where you can just have nothing and then, you know, open an account, and then you can add money as you have it available. You can buy stocks, ETFs, options, mutual funds, CDs, and even metals on Fidelity. So that, again, there's plenty of different asset classes that you can invest in, which is nice. Some people like certain asset classes over others for risk on, risk off. So they do offer all these options. You can house your taxable, your retirement, your HSA, and your trust all on Fidelity. This is personally what I have. I have accounts with Fidelity. I have my work 401k, I have my work HSA, I have my Roth IRA, and I have my individual brokerage account, my retire early account, all with Fidelity. For me, it's not like, oh, Fidelity is, head and shoulders above everybody else. To me, it's just I don't want to have to remember logins and passwords for everybody else. Multiple different sites, and Fidelity has been good. Like, I have no complaints with Fidelity, so why wouldn't I just remember one username, one password, and get all my access to information, all my investments all in one place. So, and another thing that's very, very nice and very underrated, especially for anybody just getting started, is the offering of, or the availability of fractional shares. That's huge. Basically, in the old days, you had to, if you wanted to buy a stock that cost $40, you had to have $40 to buy that stock. Now, if you want to buy a stock that costs $40 and you have $2, you can buy a fraction of that stock. And that's really nice. You have to start somewhere, buying $2 of the stock, and then next week you have, $5 to invest. You can put another $5 in the stock. Now you own $7 of the stock. So that's a really, really nice thing for helping you build positions in a company. So this is Fidelity, pros and cons, and then some little tips. Next, we're going to get into Charles Schwab. So the pros with Charles Schwab is it is widely considered to be the best site for ETFs. So there are more than 150 ways to analyze ETFs via the Street Smart Edge software. This is proprietary to Charles Schwab, so no other site has this. This is their own software. And comparing ETFs is nice because you want to watch out for overlap of ETFs. Like, you don't want to buy one ETF. Like, for example, you don't want to buy SPY and VOO. They're basically the same thing. So buying both of them, you might as well put your money into one of them. You're diversified because there's 500 and something stocks in there. It follows the S&P 500. So you wouldn't need to do that. And with this software, you can see, these are literally it'll say, this is a 99.9% match, or maybe even 100% match. I don't know if there's any differences, but the majority of it's the same. So you can use this software to find that and be like, okay, I want to buy this ETF that covers this, and then this one only 10% overlaps. It might be a good idea. It gives you some more diversification. So that's really, really nice. So the next thing is it has great research and screening tools. So again, you're going to notice a common trend here. Same thing with Fidelity. Charles Schwab also has really good research and screening tools. So you can also compare, like we just talked about comparing ETFs, you can compare individual stocks and mutual funds simultaneously with ETFs. So you can basically say, hey, I want to compare the performance of this ETF, this stock, and this mutual fund, and you can compare them all. Now, obviously, certain things apply to one that doesn't apply to the other, but it'll show you things that are in common, or things that you can actually directly compare, and you can make an informed decision whether an individual stock or a mutual fund or an ETF is right for you. Lastly, for the pros, is there's a large volume of low expense funds. So it says that there are more than 500 index funds with expense ratios of 0.5% or less with Charles Schwab. And again, this is Charles Schwab ETFs or index funds. You can get those on any website, but Charles Schwab created these funds and they manage these funds. So they're thinking, okay, you're signing up for Charles Schwab, you're going to want to get Charles Schwab things. Again, if you have a Fidelity account, I can buy Charles Schwab index funds. And same thing on, vice versa. It doesn't matter. Some of the cons for Charles Schwab is they pay just 0.01 APY on uninvested cash. So if you, make a large deposit into your account, say you're working on your Roth and you have $6,000 that you can deposit a year, you put in money at the end of each month, like I do, I put in, $1,500, let's say. I don't invest that $1,500 into actual companies right away, right? Like I dollar cost average literally every day. So I have money sitting in the account. I get less than a savings account would give me as interest on that money. To me, I've always thought I'm not really worried about the interest I'm getting on that money in there. Like to me, that money's kind of not necessarily lost, but it has a bigger goal, right? The bigger goal is to be invested into companies that are going to make me money in dividends and capital appreciation. So that is a con. You don't get a lot of APY on your uninvested cash, but also consider what it's there for. It's not there to gain interest on uninvested cash. It's there to gain capital appreciation and dividends on invested cash. So it's whatever. The last con is that it has limited fractional shares trading. So they don't really do full fractional shares like a Fidelity does, where Fidelity, like I said, as little as $1, you can buy any stock, where Charles Schwab does not do that. There has to be a certain amount that you have to invest in each company. I don't know if I don't have a Charles Schwab account, so I can't speak on this too much. If you do have one, comment down below and let me know if I'm wrong, or let the people know how it actually works. But how I'm taking this is that you have to have a certain percentage of the stock to invest in that company. Therefore, like, say a company costs $10, you can't invest $1, that's only 10% of the cost. Maybe you have to have 50% of that price. I'm not sure. Or it could just be a minimum purchase of $10. It could be a higher purchase, which, that could be, breaking point for some people. Like, maybe I don't have $10, maybe I have $5. So now they have to wait till they get $10, and then, who knows what happens to the stock between now and then. So the side bullet points we have are $0 minimum deposits. Again, certain accounts you could open. You don't need to have any money to open it. You just open the account and then invest as you're ready. Again, you can buy stocks, ETFs, options, mutual funds, bonds, CDs, metals, and futures. So a little bit more options on here, actually. Again, you can house your taxable, retirement, HSA, and trust for the kids all in this platform. Again, really nice. Like I said, I have all my stuff with Fidelity, so I don't have to remember passwords and such. And then, like I said, one of the other things is they have fractional shares, kind of. So do your research. Again, look into that. I'm not sure if it's percentage based or dollar based. I have no idea. I wanted to do that before, but I forgot. So here we are. So on to the next one. The next one of the top 3. These are in no particular order, by the way. This is just the top 3. They're all great. You're not going wrong with any of them. That's why I'm giving you the pros and cons, and you're going to do your own research because I'm just a guy on YouTube. So the pros for Vanguard is it's known for its low-cost funds and ETFs. The average expense ratio for mutual funds and ETFs was just 0.09% as of December of 2020. And the industry average is 0.54%. So as you can see, significantly less. Remember when I was just talking SPY versus VOO? VOO is the Vanguard version of the S&P 500. It's a very low expense ratio. That's why I picked them over SPY. The expense ratio is lower and they track the same thing. And they're also known for their no nonsense approach. And this is not considered to be a one-stop shop for investment research. So Vanguard's really like, hey, I already know what I want to buy. I want to buy an ETF. I'm going to go and put my money into this ETF, and that's it. If you want to do your research, you kind of have to do it on other platforms. They have some tools that you can use, but it doesn't compare really to a Schwab or a Fidelity. Some of the cons is the investment minimums are fairly high. So there's a higher barrier to entry with the minimum investment requirements, generally $1,000 to $3,000. So this is where most of their accounts, you have to have $1,000 to $3,000 to open them. So that is a considering factor. Some people don't have that much money. I didn't have that much money when I started. So if this is a barrier for you, this might not be the right brokerage for you. Next, they have underwhelming tools and data. So like I said, this is mainly used, the Vanguard is mainly used to buy and hold index funds. I know I want to buy this one. I'm going to buy it. I'm going to hold it for 40 years. I'm not going to do anything and just keep buying, don't really care. Perfect place for you. Say you have $5,000, you want to buy VOO, buy VOO, don't look at it. And then you've come into $5,000 again, $5,000 in VOO, don't look at it. Vanguard's your place. That's really what they're known for. If you want to do more than that, you might want to look at one of the other options. That's just one of the cons for them. And Vanguard also does not offer fractional shares. Real sad. I feel like most places now do offer fractional shares. Like I said, it's just nice to not have to keep money in uninvested cash in there until you get enough to buy that $40 stock. You can buy it when you have 20, you can buy it when you have 10, you can buy it when you have $1. On everywhere else, Vanguard doesn't have that. If you want to buy a $40 stock, you need $40. So the one little caveat for that is they do allow you to reinvest dividends in stocks, ETFs, and mutual funds. That's the only way you're going to get fractional shares. So say you have a $40 stock, it pays you $2 in dividends. You will then get that $2 reinvested and have a fractional share since it wasn't enough to buy a whole share. But other than that, you can't buy fractional shares, which I'm a little confused about because I feel like they already have the ability to do fractionals because of the dividends. Just turn it on kind of thing. But what do I know? So getting into the side bullet points, you can buy stocks, ETFs, options, mutual funds, CDs, bonds, and metals, all on Vanguard. Again, primarily used for ETFs. So if you're an ETF super passive investor, this is your place, but you can also buy these other things. And then you can also house your taxable retirement and your trust accounts all on this platform. So those are nice takeaways. Those are your top three. Top three, once again, being Fidelity, Charles Schwab, and Vanguard, no particular order. All right, so next I wanted to give you guys a really quick rundown of some other options that you might want to use. If you don't want to use one of those top three, you want to go off the beaten path, do your own thing, I wanted to give you guys some small options for each of those. So what we're going to do here is I'm going to list them. That's generally one for each kind of investor or experience level of investor. And I just have the pros and cons for each. I'm going to try to do this really quick to keep the video short. So first one we have is Robinhood, personally where I started. And this is known for like ease of use. I can personally say Robinhood is the easiest brokerage to understand. It's super simple. It's super clean. It's just what brings in new investors. Investing is scary for a lot of young people. Robinhood is a great platform for this to really, get you in the game. And then once you learn, most people will take their money elsewhere to a big boy platform, so to speak. So the pros for this, it's simple, fast, and easy. I kind of just spoke on that. They have fractional shares even in cryptocurrency. You'll notice that I did not mention cryptocurrency in the other brokerages. They don't offer it. Robinhood does. I personally have my crypto on Robinhood. I have not even enough crypto to talk about, so I really don't talk about it too much. But Robinhood does do fractional shares just in case. I think Bitcoin's at 38,000 today. Just in case you don't have $38,000 laying around to buy a whole Bitcoin, you can buy fractions of it, which is nice. And then they have competitive APY on uninvested cash. APY changes too often. I don't have the exact number, but basically you will get small amounts of interest for the money that you just have sitting in your account. Again, I'd recommend, starting to put that money to work, but that's a nice pro. Cons, frequent site outages. Everybody knows Robinhood was in the headlines for when GameStop was popping off and AMC was popping off. Robinhood shut down the trading on those. You could buy them, but you couldn't sell them, which is what everybody was trying to do, or it might be the other way around. Either way, they turned it off where you couldn't trade it as you wished. And a lot of people are like, oh, it's going down. I want to get out of it before I lose all my money, or it's going up. I want to buy it before it gets even more expensive. They have site outages all the time. They're also criticized for the gamification of investing, where when you first sign up, you get a free stock and you have to scratch off the little scratcher to see what your free stock is. Basically, this can lead to bad habits. It makes you think that this is, money's just for fun and you just, whatever, it doesn't matter. And then, when you end up going in the red because you made risky investments and you don't know what you're doing, it can lead to that. So that's a con for most people, or most people consider the gamification of Robinhood to be, a bad thing. And then there's limited research and screening tools. So there's not really a ton of information that you can learn on an individual company or an ETF. The ETFs have gotten better. I've seen that they actually break it down by sector weighting in the ETFs now, which is nice. When I was on it, it was just, here's this ETF, here's what it cost, here's 52-week highs and lows and stuff like that, but there's not a lot of information. You have to do your research other places, so that's a con. Next one we're going to get into is a place called Tastyworks. This is used for options trading, I found in my research. Pros to this is it specializes in the options trading. Like I said, there are low trading fees. It has good options-focused educational tools, so it teaches you what are options, how they work, maybe ways that you can better increase your opportunity to make money and reduce your risk to lose money. So those are the pros for Tastyworks. And then you have cons, which are options trading is risky. Like if you don't know what you're doing, you can lose a lot of money really quick. It lacks advanced order types, so there's not different order types that you can place your options with, and there's limited products, so it doesn't offer a wide variety of different things to use on the site. So that is Tastyworks options trading. Next, we're going to get into the day trading. So day trading is Tradestation. That is a good brokerage for that. Pros are tools catered to active investors. So if you're a day trader, you're very active in investing. You are literally looking at your portfolio, if not day by day, minute by minute, buying the candlesticks and all kinds of things. I don't do that. Trading tech might be the best in the industry. This is what's been widely considered one of the best day trading brokerages out there. And they have 40 plus years of historical data. And what this does is it doesn't necessarily indicate future success, but you can go back and use it to try to figure out trends. And it's really good for back testing. So cons to Tradestation is you must meet monthly minimum trades to avoid fees. So this is a day trading place. You have to have a certain number of orders in order to not get hit by fees. So they are really incentivizing you to make day trades because that's what they're for. And if you don't, you have to pay a fee. Again, day trading is risky. That's another con for it. And then many features for day trading are just too risky for new investors. So again, like I said in the beginning, do your own research. Make sure you understand what you're going to do before you do it. And if you lose money, it's not my fault. Next one is interactive brokers. So I watch CNBC in the morning when I'm getting ready for work. And I often see interactive brokers as a commercial in here. And what it is for is international markets, so abroad, not United States, which is where I live. Pros to this is you have access to a large number of international markets. They are an international brokerage. This is what they do. They have strong order execution protocols, basically meaning if you place an order at a certain time for a certain price on a certain commodity or a certain stock or company, it's going to fill. It's going to fill at that price at that time, which is nice. And then it is a good platform for most retail investors. Again, this is not a recommendation to go into international markets for trading, but it seems to be an easy platform to understand for retail investors, meaning you don't have to be one of those commercials where there's 800 screens around a guy. He's sitting there with a pen and a pad, and he's got a bunch of colorful lines on his screen. You don't need to do that. It should be pretty easy, relatively speaking. Some cons are trading international stocks is not free, right? So there are taxes and fees and a whole kinds of other nonsense that come with trading international stocks. So again, do your own research, find out what those are, and see if this sways you to or against international trading. And there is some to be desired for the tools and research. So basically, if you want to do international market trading, you can use interactive brokers, but you might need to do your research somewhere else. So the last two we're going to talk about, both of these are Robo Advisors. So the first one is Betterment. Betterment, the pros are you have low fees and minimums. It's easy to use, strong goal-based platform, and there's a wide range of portfolio customization. So basically you can pick and choose what you want to do. It's really goal-based. I want to retire at 50 years old. You can say, this is what I'm contributing. This is where I want to put my money at this percentage, and it does it all for you, which is really nice. Cons, there are no REITs or commodities, and commodities are raw materials or agricultural products like coffee and copper. You can't trade those on the site. It doesn't exist. And then it's less sophisticated for tax loss harvesting. Very short version of what tax loss harvesting is when you, at the end of the year, you sell your losers, and then you sell some of your winners, and to not pay taxes on those gains, you sell your losers, and it balances it out, and then you reduce your tax bill or eliminate your tax bill for your investments. So very basic version of that. Do more research on that. I'm not an expert by any stretch with that, but so those are the pros and cons for Betterment, which again is a robo advisor. The other robo advisor is Wealthfront. So this one has, again, low fees and minimums. It has a strong free financial planning tool. So there are a lot of things you can use on this website. Brokerage for research, which is really, really nice, and they're free. Everybody likes free. And then this one has a strong tax loss harvesting investment strategy. where again, this is Robo Advisors. You kind of tell it what you want it to do, and it will manage all this stuff based on algorithms and the whole 9 yards. Smarter than me for sure. Cons: portfolios under $100,000 are not that customizable. So it really, again, it's Wealthfront. I guess if you're under $100,000, you're not considered wealthy. So if you have over $100,000, you can do, little details here and there with where you want your money to go and how you want it to work. If you have under that, there are less options. There are lack of fractional share trading and portfolio balance requirements. It leads to uninvested cash. So this one, there are no fractional shares, which just leaves money in your account, because if you set up the Robo Advisor, I want to buy this company costs too much, you don't have enough money, your money just sits there because, all the algorithms and stuff say, hey, this doesn't work, we can't do it. Your money just sits there until eventually you have enough money to do, carry out your plan. So that's going to lead into the key takeaways and things to consider. So you're really going to want to consider and evaluate the following when picking where to put your hard-earned money. So what you want to do is you want to look out for fees. You want to see what minimum deposits are. You want to see about the asset classes that are available in the brokerage, stocks, bonds, CDs, ETFs, etc. Make sure it has what you want to buy, what you're into investing into. The account types. You want to make sure that if you want to open a Roth, do they have Roths? If you want to open a 401k, if you want to open a HSA, if you want to open a trust, do they have those accounts? If they don't, obviously you can't use them because they don't have what you want. You also want to check for ease of use. This is again where I like Robinhood, but you want to look at the website and you want to look at the app. If you don't want to open an account with it to find out how that is, but you can go online and find people that have those accounts and watch them use whatever it is, the app or the website, and see how it looks. Does it look friendly? Does it look like they can find them, navigate around the website? Are they always confused? They don't know where anything's at. That might be an indictment on the person, or it could be an indictment on the app doesn't work right. It's always crashing, or the website's not really labeled right. Nothing works or whatever. So ease of use is really good. Research tools and data. Do you have to use 8,000 other websites to decide if this is a good purchase or not? Or can you do all your research, all your investing for all your accounts in the same place? Again, kind of leading into that is the educational tools. If you want to learn about something, do you have to go to YouTube and watch Dividend Obsession? Or can you go on Fidelity and go to the Learning Center and learn about the same stuff I'm talking about? Or, is that an option? And then lastly, important for some people, not important for others, is customer service. So again, when I had Robinhood, they had no customer service. They now have a customer service. I've been told Fidelity's customer service is really good. I hope that I do things right enough and have not enough problems to not need customer service, if that makes sense. So I don't really hope to ever need this one, but if you have a lot of questions and you like to talk to individual people, or you generally find yourself in a pickle, maybe customer service is more important for you, and not only having customer service, but having quality customer service. So do your research here and find out, read some reviews and find out what people are saying about that. So those are the key takeaways, things to consider when you do your own research. I don't know if you guys want to write those down and then just kind of do your own spreadsheet or Word document and say, hey, which one of these should I consider? Which one's right for me? All right, so that's actually going to wrap it up for today's video. Please like the video if you guys learned anything, or if you guys enjoyed the content, if you guys think I'm funny, whatever. Just like the video. It really helps the channel. Comment down below if there's any video suggestions on this video, if you guys have any video suggestions for future videos. And then also, don't forget to comment if you subscribed. I'll make sure I personally comment back to each and every one of you. And until next time, see you.